Welcome to StudyVix YouTube channel. Always study smart and master your future.
It is wonderful to be here. And today we have a very special session lined up, and frankly, I am quite excited about it.
Me too.
We are sort of shifting gears from our usual broad overviews to something, specifically tailored for the dedicated students out there.
Right, especially those navigating the, let's be honest, intense waters of the CA intercurriculum.
Exactly.
So we're putting on our professional educator hats today. We're going to tackle a subject that sits in the corporate and other laws paper. And it's a chapter that I think often scares students. It has this reputation for being technical, a bit dry, and just full of jargon.
It does.
But having gone through the material, I think it's actually one of the most practical and, interesting parts of the entire syllabus. We're opening up Chapter 15, the Foreign Exchange Management Act, 1999.
Also known as FEMA.
FEMA, exactly.
And, FEMA is essentially the rule book for how money moves in and out of India.
Yeah.
And before anyone tunes out thinking this is just dry legal theory, I want you to just look at the world around you. We live in a completely globalized environment.
It's everywhere. I mean, you might subscribe to a streaming service that's based in the US, right? You're paying a few dollars a month.
That's a forex transaction.
Right. Or an Indian company in Gujarat might be exporting textiles to Europe. Or, and this is so common, someone might be sending money to their elderly parents back home in India from Canada or Dubai.
Constantly. Money is crossing borders all the time.
All the time.
Precisely. And the fundamental premise of this act is that you can't just, walk across the border with a suitcase full of cash.
No.
And you certainly can't just wire $1 million to anyone you like without following some pretty specific procedures. The Indian rupee, it's not fully convertible in every sense, so there has to be a gatekeeper.
And that gatekeeper is FEMA.
That is where FEMA comes in.
So our mission for this deep dive is to break down this complex legal language into clear and, more importantly, exam-ready concepts. We're not just going to read the act section by section.
No, that'd be boring.
We're going to understand the story behind it. We'll look at its history, which is actually fascinating, its scope, the crucial definitions in Section 2, and the absolute heart of the act.
The distinction.
The distinction between capital and current account transactions.
That distinction is, I would say, the golden rule of FEMA. If you get that right, you can answer almost any question the exam is going to throw at you.
Okay, so let's unpack this. But before we get to the definitions and all that, I think we need to set the scene. Why do we even have this act? I mean, laws don't just appear out of nowhere. FEMA replaced an older act, didn't it?
It did, and understanding that lineage, that history, helps you understand the whole tone of the current law. To really grasp FEMA, we have to go all the way back to 1939.
1939.
Wow. Yes, this was the era of British rule, and World War II was kicking off. The British introduced something called the Defense of India Rules.
So the origin of our forex laws is actually a wartime measure. That's incredible.
It is. It wasn't about economics at all. It was about survival and war. It was about controlling resources for the war effort.
Okay.
Then, after independence in 1947, we enacted the first Foreign Exchange Regulation Act, or FERA. But the version that really defined the Indian economic landscape for decades, and the one that, older businessmen still have nightmares about, was the FERA of 1973.
FERA, even the acronym sounds a bit stricter than FEMA. FERA versus FEMA. What was the vibe of 1973?
It was much, much stricter. You have to remember the economic context of India in 1973. We were a very closed economy.
Right.
Foreign exchange was incredibly scarce. I mean, the country didn't have these large reserves like we do today. So the whole objective of FERA was conservation.
Conservation, like you're conserving water in a drought.
That is the perfect analogy. It was about hoarding every single dollar and pound we had. It was a policing act. The mindset was, you cannot do this unless we give you very specific permission.
So a presumption of guilt.
It was. If you dealt in foreign currency without a permit, it was treated almost like a criminal offense.
Right. It was guilty until proven innocent, in a way. Dealing in foreign currency was just viewed with suspicion. But then everything changed.
1991.
1991. The year of liberalization.
That was the turning point for the entire Indian economy. We faced a massive balance of payments crisis, and we basically had to open up. We embraced globalization, free trade, and cross-border capital flows. We started inviting foreign investment into India.
So if you're inviting foreign companies to come and invest in India, and you're telling your own Indian companies to go global and acquire assets abroad, You can't have a law that treats every single foreign transaction as a potential crime.
You absolutely can't. The old FERA framework was becoming this massive bottleneck. It was actually hindering growth. We needed a free movement of forex for trade, and we needed to make investors feel welcome, not threatened.
So the government realized we needed a shift.
A huge shift from regulation to management.
And that's the key philosophical shift, isn't it? From FERA to FEMA, from conservation to management.
That is the most important takeaway for the history section. FERA was about policing and conserving. FEMA is about facilitating. So FEMA was enacted in 1999, but for the students listening who need to memorize dates.
Yes, this is important.
It came into force on a very specific day, June 1st, 2000.
June 1st, 2000. Everyone note that down.
Absolutely. The preamble of FEMA actually states the objective very, very clearly, and it's worth paying attention to. It had two main goals. The first is facilitating external trade and payments.
Okay, meaning we want to make it easy to do business. Simple as that.
Right. And second, promoting the orderly development and maintenance of the foreign exchange market in India.
I love that word, orderly. It doesn't mean restrictive, it just means organized.
That's a great way to put it.
We want a market that functions smoothly, not the Wild West, where currency values are fluctuating wildly because of speculation.
Correct. It represents a shift from a control mindset to a regulatory mindset, where the government is now a facilitator. We aren't trying to stop the flow, we are just channeling it properly.
Okay, so we've moved from the strict FERA era to the management-focused FEMA era. Now, let's look at the book itself. How is this act structured? If a student picks up the BEAR Act, what are they looking at?
It's actually a surprisingly compact act, given how much it controls. It has 49 sections divided into 7 chapters.
Yeah.
But here's the trick to reading FEMA, and this is where so many students get confused. The act itself is just a skeleton.
Right.
The real muscle, the details of what you can and cannot do, that comes from the rules and regulations.
And in common parlance, we use rules and regulations interchangeably. But in law, and specifically in FEMA, there is a very distinct difference, isn't there?
It's a crucial legal distinction. In the context of FEMA, rules are notified by the central government, so that's the Ministry of Finance.
Okay, the government.
Regulations, on the other hand, are notified by the Reserve Bank of India, the RBI.
That is a vital distinction to make. So the political executive, the government makes the rules, and the central bank, the RBI, makes the regulations.
Yes. And generally speaking, and we'll get to this in detail when we discuss the transaction types, the central government makes rules about current account transactions, while the RBI makes regulations about capital account transactions.
That is a great rule of thumb to just memorize right now. Central government for current, RBI for capital. We'll dig into why that separation of powers exists in just a moment. Now, let's talk about the reach of this act. Section 1 covers the extent and application. Obviously, it applies to the whole of India, but it goes further, right?
Yes, it does. Section 1 has what we call a long arm. It extends beyond the geographic borders of India in some very specific cases. The Act states it applies to all branches, offices, and agencies outside India.
Okay.
If they are owned or controlled by a person resident in India.
Now, this is interesting. Let's paint a picture here. If I'm an Indian resident and I open a branch office in, say, Dubai or London to handle my international clients, FEMA applies to that office.
Yes, if you own or control it. The logic is that the economic interest lies in India. The brain of the operation is here. So if that branch violates forex laws, the Indian owner is liable.
So you can't escape it just by being physically abroad?
No. The Act explicitly captures contraventions committed outside India by any person to whom this Act applies.
That phrase, owned or controlled, seems to be the real trigger. It prevents people from just setting up a shell company in a tax haven and claiming, oh, that's not an Indian entity, FEMA doesn't apply to me.
Exactly. It casts a very wide net to ensure that Indian residents cannot bypass the law simply by stepping across the border. It makes sure that the economic sovereignty of India isn't undermined by offshore entities controlled by Indians.
Okay, that's clear. So moving on to Section 2. In any law, the definitions are the building blocks. If you don't understand the definitions, you can't understand the provisions.
Absolutely.
There are a few key ones here. Let's start with authorized person.
Right. Section 2C defines an authorized person. This is central to how the entire forex market works. An authorized person, or an AP, can be an authorized dealer, which is usually a bank,
Okay.
a money changer, an offshore banking unit, or basically any other person authorized under Section 10(1).
But why is this definition so important? Why do we need to know who these people are?
Because Section 3 of the Act basically says You cannot deal in foreign exchange with anyone except an authorized person.
So no side deals?
No. You can't just go to your neighbor who has some spare dollars from a trip and buy them. You can't buy euros from a friend. You have to go through the banking system or a licensed money changer.
They are the official gatekeepers.
Precisely. The authorized person is deputized to check if your transaction is legal, if it falls within the limits, and to report it. Without them, the RBI would be completely blind.
Okay, what about currency? That's Section 2H. I assume it just means rupee notes and dollar bills. Why do we even need a definition for something so obvious?
Because in the modern world, money takes so many forms. The definition is really broad. It covers currency notes, sure, but also postal notes, money orders, checks, drafts, traveler's checks, letters of credit, bills of exchange, promissory notes.
And what about plastic? Credit cards?
Yes, absolutely. Credit cards, debit cards, ATM cards, essentially anything that facilitates a payment. So when you go abroad and swipe your credit card, you are dealing in currency under FEMA.
That makes a lot of sense. If they only regulated physical cash, everyone would just use plastic or digital transfers to bypass all the limits.
Exactly. The law has to be technology neutral to be effective.
Now, there's another huge definition that we should touch on. It's about residential status person resident in India versus person resident outside India.
That is a massive topic in and of itself.
Yeah.
It's largely dependent on the number of days you spend in India, specifically that 182-day rule and the purpose of your stay. It determines who is regulated. However, for our deep dive today, I think we should focus on the nature of the transactions. Because even if we know you're an Indian resident, the rules change drastically depending on what you're actually doing with the money.
Right. And that brings us to the core of today's discussion. Section 4 of our outline, the big one. The distinction between capital account transactions and current account transactions.
This is the heartbeat of FEMA. If you can understand this, you have won half the battle. The Act splits all foreign exchange transactions into two big buckets, capital account and current account.
And they're mutually exclusive. A transaction can't be both.
Never. And the best way to visualize this, especially for commerce students who are already deep in accounting, is to think of financial statements.
You mean like the balance sheet and the profit and loss account?
Exactly that analogy. It works perfectly. Think of capital account transactions as items that would affect your balance sheet. They deal with assets and liabilities. On the other hand, think of current account transactions as items that would go into your profit and loss account or a revenue account. They deal with income, expenses, and trade.
I love that analogy. That makes it so much clearer than just reading the legal text. So, okay, let's look at the legal definition with this analogy in our minds. Section 2E defines capital account transactions.
Right. The definition states, a capital account transaction is any transaction that alters the assets or liabilities, including contingent liabilities outside India of a person resident in India.
The PRII.
Right. Or conversely, a transaction that alters the assets or liabilities in India of a person resident outside India.
A PROI. Okay, let's unpack that. Alters the assets or liabilities. So if I, an Indian resident, decide to buy a house in London.
You're creating an asset. Where's that asset located?
Outside India.
Does it alter your asset position abroad? Yes. Therefore, that is a capital account transaction. It's a balance sheet item.
And if I take a loan from a bank in New York to fund my business?
You're creating a liability. The lender is outside India. It alters your liability position abroad. That is a capital account transaction.
What about the reverse? If a foreigner, a PROI, comes here and buys a factory in Mumbai.
That foreigner is creating an asset in India.
Yeah.
So for them, and for the purposes of FEMA regulating that inflow of money, that is a capital account transaction.
It seems pretty straightforward. If it builds an asset or a debt across the border, it's capital. Now let's go back to our rule about who regulates what.
This is where we go back to our rule of thumb. Capital account transactions because the rupee isn't fully convertible on the capital account yet. We still need to manage these flows carefully to maintain economic stability. We don't want massive capital flight out of the country suddenly.
Got it. So capital account equals balance sheet, assets liabilities regulated by the RBI, and it's generally restricted unless allowed.
Perfect summary.
Now, let's flip to the other side. Section 2J, current account transactions.
The definition of a current account transaction is actually quite funny. It's defined negatively.
What do you mean?
The Act simply says, a current account transaction is a transaction other than a capital account transaction.
That's it, just everything else.
Essentially, yes. If it doesn't alter assets or liabilities cross-border, it must be a current account transaction. But thankfully, the Act does give us specific examples to help clarify, and these align perfectly with our P&L analogy.
Right, let's go through those inclusions because they really help paint the picture.
Okay, first one, payments due in connection with foreign trade, other current business, services, and short-term banking and credit facilities in the ordinary course of business.
So, importing goods, paying for a legal consultant in Singapore, or getting short-term trade credit, these are all day-to-day business activities, just like the P&L account.
Exactly. The second one is payments due as interest on loans and as net income from investments.
Okay, this is a nuance that students often miss. Taking the loan as capital, but paying the interest on that loan is current.
Yes, you spotted it perfectly.
Yeah.
The loan itself creates the liability. That's capital. That's your balance sheet. But the interest payment is a recurring expense. That's current. It's your P&L.
Just like in accounting, the principal is the liability, the interest is the expense.
It holds up perfectly.
Okay, what else is included?
Remittances for living expenses of parents, spouse, and children residing abroad, and also expenses in connection with foreign travel, education, and medical care of parents, spouse, and children.
So, me sending money to my son who's studying in Canada for his rent and tuition fees.
That's a current account transaction. You are buying an asset over there. You're paying for consumption and services.
And who regulates this bucket?
The central government. Yeah. Through the Ministry of Finance. They are the ones who issue the rules.
And are these permissible?
Yes. Section 5 says that any person may sell or draw foreign exchange for a current account transaction. They are freely permissible unless the central government has imposed a reasonable restriction.
So the default logic is completely flipped. For capital, it's restricted unless permitted, but for current, it's permitted unless restricted.
Precisely. India has accepted full convertibility on the current account. We want trade and travel and education to flow freely. We only step in and stop it if it's harmful or excessive.
This is a great framework, but I know for a fact that exams love to throw curveballs. They create these scenarios that look like one thing but are actually the other.
They do.
So let's move to section 5 of our outline, case studies.
Let's do it. These are the tricky scenarios that test if you really understand the definition, not just memorize it.
Okay, scenario A, import of machinery. Let's say I'm an Indian factory owner. I import a massive machine from Germany for my factory. In my accounting books, I debit machinery account. That's a fixed asset. It's capital expenditure. So logic would dictate that under FEMA, this is a capital account transaction, right?
This is the classic trap, and the answer is a resounding no. Under FEMA, this is a current account transaction.
But why? It's an asset. It sits right there on my balance sheet.
It's an asset in your books in India, yes. But look very carefully at the definition of a capital account transaction under FEMA again. Alters assets or liabilities outside India. When you pay that German vendor, do you now own an asset in Germany?
No, the machine is shipped to me in India. I own it here.
Exactly. And do you have a continuing liability to the German vendor after you've paid?
No, I paid them in full. The transaction is settled.
So from the cross-border perspective, no asset was created outside India, and no liability remains outside India. The transaction is over. Therefore, it is simply foreign trade. It falls under payments due in connection with foreign trade.
So it doesn't matter if you're importing raw material, which is a revenue expenditure, or heavy machinery, which is a capital expenditure. Under FEMA, the import of any goods is always a current account transaction.
Correct. Do not confuse income tax definitions or accounting definitions with FEMA definitions. They are different worlds with different purposes.
That is a crucial distinction. Okay, scenario B. I want to send a gift to my brother. He's an NRI living in New York. I send him $1,000.
Okay, you send the money, he receives it.
Is that capital or current? I mean, in tax law, gift might be treated as a capital receipt for him.
Again, just apply the FEMA test. Once that gift is accepted, do you own an asset in New York?
No.
Does your brother owe you the money back?
No, of course not. It's a gift.
So the transaction is over. No cross-border asset or liability remains on anyone's books. Therefore, it is a current account transaction. It falls under remittances for living expenses or just general remittances.
So unilateral transfers like gifts and donations are current account.
Yes. It's a flow of funds, not a creation of a balance sheet item.
Okay, let's look at scenario C. This was actually an MTP question, I believe. A famous film star wants to perform in New York for a Diwali event. They need to draw $20,000 for their team's expenses, flights, hotels, things like that.
The cultural tour scenario. So, First things first, let's categorize it. Is it creating an asset or a liability across the border?
No.
It's an expense for a service or an event, so it is a current account transaction.
Okay, so it's current. That means it's freely permissible, right? I can just walk into the bank and get the dollars.
Well, this is where the second part of the rule comes in. Freely permissible unless reasonably restricted by the central government.
Ah.
The central government has issued rules, specifically the Foreign Exchange Management, Current Account Transactions, Rules 2000. These rules have schedules.
Schedules, like
Yeah.
the list of do's and don'ts.
Exactly. Schedule I prohibits some things entirely. You just can't do them. Schedule 2 requires prior approval from the government, and Schedule 3 requires RBI approval if the amount is over a certain limit.
Okay. So where does our film star fall?
Cultural tours often fall under Schedule 2. This means they might require prior approval from the relevant ministry, like the Ministry of Human Resource Development or Culture. So for an exam answer, you'd say it's a current account transaction, but also note that it might require central government approval as per the rules.
So the big takeaway here is just because something is a current account transaction doesn't mean it's a total free-for-all. You still have to check the schedules.
Exactly. Some things are totally prohibited, like using forex for lottery tickets or banned magazines. Some need approval. But the nature of the transaction itself remains current account.
This is crystal clear now. That balance sheet test is the ultimate filter. If it doesn't leave a footprint of an asset or a debt across the border, it's almost certainly current.
That is the best way to think about it.
Okay, now let's move to Section 6. We've talked about what you can do. Let's talk about what you absolutely cannot do, the prohibitions and the enforcement. Section 3 of the Act.
Section 3 is the don'ts of FEMA. It lists the prohibited activities. And the first and most important one, which we touched on earlier, is dealing in or transferring foreign exchange to anyone other than an authorized person.
So a strict, clear prohibition on the black market.
Yes. And it also prohibits making payments to the credit of a person resident outside India in any unauthorized manner.
And receiving payments in the same way.
Correct. Clause C prohibits receiving payments from outside India in any unauthorized manner. This is often linked to what we call hawala.
Right. And speaking of hawala, there's a very specific clause in Section 3 about assets. Can you explain that one?
Yes, Section 3D. It's a bit wordy, but very important. It prohibits entering into any financial transaction in India as consideration for acquiring an asset outside India.
Can you break that down in plain English? Financial transaction in India as consideration for acquiring an asset outside India.
Sure. Imagine you want to buy that house in London, but you don't want to send the money through the official banking channel because of limits or taxes or whatever. So you find a guy in Mumbai whose brother lives in London.
Okay, so I find a local contact.
Right. And you pay that guy in Mumbai, say, 1 crore rupees in cash.
Okay, so I've handed over cash in Mumbai.
And in return, his brother over in London pays the seller of the house the equivalent amount in pounds.
Ah, I see. So the money technically never crossed the border. I paid in rupees in India, and the seller got paid in pounds in London.
Exactly. But look at the end result. You created an asset outside India, the house, by making a payment inside India. Section 3D specifically prohibits this. It's a compensatory arrangement, and it's illegal because it completely bypasses the banking system and the foreign exchange reserves of the country.
Wow. That closes a huge loophole. They really thought of everything.
They had to. Money launderers can be very creative.
So we have all these rules. The RBI manages the flow. The central government makes the rules for the current account. But who holds the stick? Who is the enforcer?
That brings us to Section 76, the Directorate of Enforcement.
Commonly known as the ED. We hear about them in the news all the time.
All the time. And it's important to distinguish the roles here. The RBI is the administrator and the regulator. They set the policy. But the Directorate of Enforcement is the investigative and enforcement agency.
So if I break a FEMA rule, it's the ED that comes knocking on my door.
Correct. They are the ones who investigate contraventions. The Act provides for adjudication of penalties and compounding of offenses. There's a whole hierarchy for appeals going up from the special director to the appellate tribunal. But the boots on the ground, the ones investigating the hawala rings and the unauthorized transactions, that is the Directorate of Enforcement.
It's a very robust system then. You have the policymakers in the government, the regulator in the RBI,
Right.
gatekeepers, which are the authorized persons, and the enforcer, the ED.
It acts as a complete system of checks and balances to ensure the main objective of the Act, which is orderly development and management, is actually met.
This has been such a comprehensive walkthrough. Let's try to summarize the journey we've been on today for everyone listening.
We have covered a lot of ground. We started with the evolution, right? From the policing days of FERA to the management era of FEMA that began on June 1st, 2000. We emphasized that the goal now is facilitating trade, not blocking it.
We looked at the structure 7 chapters, 49 sections, and the crucial role of the authorized person as the only legal way to access the forex market.
And then we spent a good amount of time on the core concept, capital versus current account. And I'll say it again, remember the balance sheet analogy. If it alters assets or liabilities cross-border, it is capital, and that's RBI's territory.
And if it's trade, travel, services, or income, it's current, and that's the central government's territory. And we busted the myth that importing machinery is a capital account transaction.
It's current because it leaves no cross-border footprint. And finally, we looked at the strict prohibitions against any unauthorized dealing and the role of the Directorate of Enforcement in keeping the whole system clean.
It really connects all the dots. FEMA isn't just a list of rules to memorize, it's a logical framework for how India interacts with the global economy.
Absolutely. And for the students listening, if you just keep that balance sheet versus P&L distinction in your head, you will be able to solve 90% of the problems the exam throws at you.
And that is the goal. Well, that brings us to the end of this deep dive into FEMA. We really hope this has turned a scary technical chapter into a manageable and maybe even interesting one.
Indeed. Study smart, understand the logic behind the law, and it all becomes much, much easier.
If you like the audio lecture, then do not forget to hit the like button, share content, and subscribe our StudyVix YouTube channel.
Don't forget to like and subscribe.